How do I see how my portfolio is performing? This is a classic question we get from clients, and obviously performance is extremely important. You don't invest your money for it to sit still and not do anything. You invest your money for it to grow and to provide for you in your retirement. However, in this day and age, what I can say is with 24/7 access to portfolios, you can check in on your app, you can check in online, no matter where you are in the world, you can go and see your portfolio live value at any point in time, generally with a breakdown of the underlying funds. I would say this is extremely unhealthy for retail investors. Over the past decade, technology has gone bang, and we have everything at our fingertips now. When it comes to investing though, this is not always for the best, and I'm going to explain that in today's video. As always guys, please like and subscribe to the channel below to let YouTube know that we're doing a good job and to share our content with more people. So, the reason I say this is not a good idea for a lot of people is having instant access to your account is something which is new over the past decade or so. When you invested your money 10 years ago or 20 years ago, you invested your money and you sat and waited. You were patient and you waited for the long-term returns. That's not what happens anymore. People invest their money and they expect to see an instant return. Or within 6 months or 12 months, the portfolio is flat. You get emails from clients, oh, I think we need to change something. And it's like, with no disrespect to the retail client, it's like, we don't need to change anything. The portfolio is correct, it's diversified, it's invested in all the correct areas. What's happened inside the markets can't be controlled by a retail client, and it can't be controlled by us as a financial advisor. No matter whether it's a recession or going for a war, markets will do their thing. However, you need to take a much, much longer view. If you look at, say, the past 20, 30, 40 years of returns, you see that upward trend. But along the way, you have a lot of noise, white noise we refer to it. So when you're checking your portfolio on a daily, weekly, or a monthly basis, I would say this is really unhealthy behavior, and it's going to increase your emotions with your investing, when unfortunately emotions are the very last thing which needs to be involved when you're investing your money. And this is one of the key reasons why retail investors often struggle managing their own portfolios, because they buy and sell emotionally at the wrong times, always trying to chase the market. And they get FOMO when the markets have gone up and they buy more, and they get scared when markets go down and so they sell. So the answer to this question is yes, you can check it all the time. However, as I say to all of my clients, you should be checking your portfolio annually. January or February, when I do my forward annual planning meetings for my clients, that's when you should be checking your portfolio. Now, a lot of you will say, absolutely not. I don't feel comfortable with that. I want to check it more than that. Okay, fine. Go and check it biannually or even quarterly at an absolute maximum. Anything more than that, you're simply causing yourself stress and drama for absolutely no reason at all. You cannot control equity markets. There's no point checking your portfolio on a daily basis. Also, when you're investing in something such as a SIP, it's almost certain you're investing this for a 5, 10, 15, 20, 30 year period. Possibly you're even going to pass it on to your grandchildren. So you have to ask yourself, why am I looking at the performance now when I'm not planning to draw down this capital for however many years in the future? Now, the very best returns come to clients who take a long-term view and are not trying to play the markets, go in and out on a short-term basis. So that's basically my summary. I know a lot of you might disagree with this and say, no, I want to be checking my portfolio all the time, but I can tell from my clients who don't check their portfolios on a daily, weekly, quarterly basis, because I've advised them to, generally speaking, over the course of time, they have much better returns than those clients who are trying to check them on a more frequent basis. It really doesn't lead to better portfolio results in my experience of dealing with clients. I hope you found that video useful today. It's a top tip from ourselves to always be checking your portfolio less regularly and let the markets do their thing rather than trying to micromanage your portfolio.